1,000 points today, I would not have done anything differently with my day or my clients' accounts because I've already done what I'm supposed to do. Have people invested according to their time horizon, their risk tolerance, their financial goals. Usually people have more than one goal. And I have clients who of all ages. I have clients who are retirees, who are just starting out, Gen Xers who are in between. So we go through all the cycles here, and I've been doing this for 30 years, and I've seen so many different scenarios and situations that's really what gives me the ability to help my clients. So that's what's going on with the market. Now, what should you do about it? If you haven't rebalanced, if you are retired, close to retire, if you have a goal coming up, it is not too late to rebalance. Maybe you still have too much money in stocks and cut that down a little bit. But if you're younger, and if you're just starting out, if you're 25, 45, dare I say 55, let's say 50, you should hope the market goes down. A down market is your friend. And I say that because you're still in the accumulation stages of building your net worth, of investing your 401k, your IRA, your regular taxable accounts, your joint account, your individual account. You're still accumulating stocks. Would you rather accumulate stocks when they're at all-time highs? Or would you rather get a break once in a while, a sale once in a while? So for most people, a down market is a good thing. If you think about all the people who were brave enough to buy stocks in 2008, 2009, or in 2001, 2002, or basically throughout the entire decade of the 1970s, think about how well those people have done with their stocks. If you think about Warren Buffett, who just released his shareholder letter a few days ago, he bought huge positions of stocks in the 60s and 70s when we had a 12 to 15 year period when stocks were greatly out of favor. I think he's done well with that decision. So what you need to do is control your behavior, how you react to down markets. Most of you need to keep investing and stay invested. And even if you are retired, I'll say, for example, and I have clients in this case, let's say around 70-ish, okay? Those clients still have money invested in the market because that money is expected to outpace inflation costs, over the next 15, 20 years or more. Doesn't mean that those clients don't have an account with just, let's say, near-term cash equivalents and then an intermediate risk portfolio. I do that a lot with my clients. I break their portfolios up into 3 different buckets. So you have the long-term stock portfolio. So the market tanks, we say, hey, you don't have to worry about that because that's for 20 years out, 15 years, 25 years out. Then you have your balanced portfolio, stocks and bonds, and then you've got your income and growth portfolio, which would have other types of securities, more stable securities. And that's the first place you would dip into when you need cash for financial obligations, just basically to live on your passive income. So that's what this is about. Why should screen stocks, it's like a whole category of stocks I just created, screen stocks, why should they be down? I mean, are you going to stop watching YouTube and doing searches on Google because of the coronavirus? If anything, you would do more searches. Coronavirus is a pretty big term in the search category. If you have money for your retirement, your 401k, and you're investing consistently, keep doing it. You don't have to do anything. Keep doing it. If you bought stocks on a spec in your individual account, let's say you took a shot on the Beyond Meats of the world, or the space, the Virgin Galactic. Okay, I think that was up today. I haven't checked, but it was up earlier in the day. Believe it or not, it was down, then it recovered. If you're taking really speculative positions, let's say a Smile Direct or something, if you're really worried about losing money in these stocks, well, and that's not the money that you wanted to lose, then you shouldn't be in those stocks. Okay. But if you are looking to, say, get into some higher quality stocks, some of the dividend paying stocks that have taken a dip in this market, like let's say, big dividend paying stock in the telecommunications space. If I start naming too many stocks, I don't want to come off like I'm recommending individual stocks in this stream. But if you take a look at the two big telecommunication stocks in this country with nice dividend yields, why would those stocks go down? Are people going to stop using their 4G LTE service? Are they going to stop making phone calls and watching YouTube videos on their phones, on their smartphones? No, nobody's going to stop any of this stuff. So I wouldn't overreact. So interest rates, inverted yield curve, I'll give about 5% of the downside today to the inverted yield curve. And I'm going to throw another 5, you could up this to 10% to Bernie Sanders. Hate to get into politics, but he is you see his position. It is a pretty rough position toward capitalism. And we all agree, like Warren Buffett said this weekend, he said it this morning, there are some problems with capitalism. Not everybody has participated as much as they could or should, but you don't want to kill, as Warren Buffett said, you don't, and he is in the past supported Democrats, and he said, you don't want to kill the golden goose of capitalism because that's where the money comes from. If you kill capitalism with, let's say, over distribution, then it just means we all have a little less. So there's a lot of political stuff going on too, and it's just that we're in a very heated environment. So there is a lot of uncertainty going on right now. So I'm going to end it like this because it's a little bit longer in the stream than I thought I would be. And everyone who's out there, thank you so much for sticking around with me. Don't overreact. I said this in a recent CNBC article. Okay, I will share the screen and then we'll get going. Okay. I recently said this. If you could see it, okay. I don't know if you could see it on your screen. If this doesn't last for a long time, then I think investors expect a rebound in demand and the stock market, will recover. If this goes on for a few more weeks, you can basically kiss the entire first quarter goodbye. We're past that point already. And then earnings estimates and global GDP would be on the chopping block. If you expect that to happen, then a sell-off is justified. I said that a couple of weeks ago in the CNBC article. I still feel that way. If the rest of this year is basically shot, then a sell-off does make a lot of sense. So keep some powder dry. If you're looking for certain stocks or ETFs, buy with limit orders, buy carefully, buy slowly. Don't be here and think you're going to catch the bottom. This is more about discipline than catching bottoms. Discipline is something you can always have. Catching bottoms is something you'll almost never hit. So that is the story for today.